Okay, hello everyone, welcome back again to this SAFOREX Academy. My name is Jesse Samuel, and in this tutorial, this edition we'll be talking about premium and discount. Of course, this is the introduction level, but you're going to get it. Alright, so what is premium and what is discount? You know, before we continue, if you have not subscribed to this channel, kindly do that. Click on the subscribe button, like our videos, and help us share to reach more and more people out there. So as of today, we are diving into one of the most important concepts that will shape the way you understand price delivery, and that is premium and discount zones. Okay, this concept is a game changer when it comes to buying or identifying where to buy, where to sell, and why the market reverses from certain zones and not others. Now, before we dive into the deep explanation, I want you to get this clearly. Markets are moved by smart money. I mean the institutional traders, the big banks, industries, and the likes, algorithm traders, are not by your $50 or $100 or $1,000. No, those players don't just buy markets randomly or sell markets randomly. They look for what is called value in price delivery. Okay. For instance, let me ask you, would you buy something at let's say when something is expensive or when it's cheap? Of course, know that the answer is very, very clear. Nobody want to buy something when it's expensive. Okay, everybody want to buy something at a cheaper price. Okay, you want discount. Even when they tell you that the price of something is 1,000 naira, for instance, you still want to price to maybe 900, 700. Okay, that's even some people are even looking for pricing to pay that value for 500 or 450. You know, that is what it means. So but when you are selling something, you want to get it at premium. Maybe you want to sell an iPhone, for instance. You're looking for people will pay you higher, bid you with higher prices, right? So the same thing is applicable to the forex market. The same logic is applicable. So you buy at discount and you sell at premium. So that's the whole philosophy behind this concept. So you buy at discount and you sell at premium. Okay, so let's take it step by step. Let's break it down. When you are dealing with premium and discount, the first thing you need to identify is what is called a range. And what is a range? A range is actually the difference between a previous swing high and a swing low. Or let's say, okay, what is swing high? I think I've done it here several times. But let's just draw something here. You see, it swings let's say 3 candle pattern formation. Let me just say I have this candlesticks here, and I have another candlestick, let me say at the center like this, and I have another candlesticks at the mid down part like this. So this 3 candle pattern formation is what we call swing high. This is swing high. Okay, this like this 3 candle pattern formation is what we call a swing high. Why if it's like this, it's actually called a swing low. That means what I'm saying is if it's sorry, don't mind my diagram for now. Now if it's below like this, okay, it's what called a swing low. It's what called a swing low. If it's below like this, it's called a swing low. But if it's above it, we'll call it swing high. We'll call it swing high, right? So now when market is actually retracing, you know, for instance, let's say in a bullish market, where market is forming consistent highs and lows, what actually starts retracement, okay, is always a swing highs. And for impulsive movement, but impulsive leg is we swing low. I hope you know what is impulsive leg means. Okay, as market is from this consistent higher highs and higher lows, right? This retracement, okay, from this high to this low is a retracement. This retracement will always begin with a swing high, okay, and when this leg want to begin, it will begin with a swing low. Basically, of course, not always, but in most cases, it begins with swing low. So with swing lows and swing highs, they actually begins retracement and reversals at times. So take note of it. You can check through your chart, you will see it repeatedly. So that range concept is what you want to look at. Another thing you want to see is maybe previous day highs or previous day low. Okay, previous day high or previous day low. You know, every day the candlesticks or of the chart ends or closes by forming a close, right? We know that a candlestick has four major informations. We've explained that a candlestick has four major informations. It has the body, it has the open for a bullish candle. Let's say for a bullish candle, we have price opens at the bottom, right? Then traded lower to create a wick, and at that again, then it traded higher and, create another high, then finally close at this body here. Now assume this is a full day candle formation. What you see that price, what you see that this is the high, okay, so I can say I want to look for previous day high or previous day low. So when I'm talking about range now, I can say that the difference between the opening price and the closing price of a particular day candle. Okay, another thing you want to see is any significant price leg, like I talked about the retracement um aspect of this price leg. Okay, so the difference between this high and this low is a range. Okay, or the difference between this high, this low, and this high is also what? A range. So now once you mark out that range, then we divide that range into two equal halves. So two equal halves. So let's assume this market now from here to here is a range. That's an impulsive leg, and we're expecting that price will definitely come back to do a retracement. So if I'm dividing into two equal parts now, let me just pick these drawing tools and just say, let's assume this is the half of it. Of course, you use your Fibonacci to know the half, the 50%. So let me just use the Fibonacci tool instead then. Okay, so if I pick from this low to this high, right? So I have here as 50% of it, of the price leg. So below here, from here, anything above this 50%, like this. Let me change the color. Sorry. Let me make it thicker so you can just see what we are doing. So anything above this 50% is premium, okay, and this anything below this 50% here is called discount. Okay, then from this here to here is called discount. Why this 50% itself is called equilibrium. Okay, it's called equilibrium. Now in a bullish market, that means when market is actually going up, right? You want to buy, you want to look for a buy. You don't buy when price is at this premium. That means anything above this 50%, even if you know that price is still going up, you don't buy. That's why I don't do buy stop. I said that in most cases I don't do buy stop. That's why I know that price is still continue up. You don't just jump and buy Once it's above 50%, you don't just buy. You wait for price to come into the discount or at this equilibrium. Yes, at this equilibrium before you buy the market. And once you buy it, you'll be targeting the premium. That means this high or anything above the high. Okay. Meanwhile, in a bearish market, that means when price is actually going down like this, when price is relating downward like this, you also want to mark the range. You also want to mark the range. You know, in premium, you also want to mark the range and see that you don't sell when price is actually okay. In this place also too, you don't sell when price is in discount. You sell when price is in premium. From here, for a bearish market like this, here is the discount. This front here is the premium. Okay, above is the premium. So you want to sell when price has retraced above this 50% here and come into this place, and you sell and come down. Same logic, simple logic, but very, very powerful in your trading journey. Okay, so we want to assume that price move from point A, which I assume is a swing low, okay, to point B, which is swing high. Let's make another schematic. Sorry, let me make another schematic. So let me assume I have price doing this, right? So price has created this movement for me, right? So this is a swing low. This is a swing low, okay, and this is a swing high. So I'm trying to repeat what I did above here, because most of you may not get it. Okay, now this Fibonacci 2, your own may not be like mine. Your own might have different numbers, okay, but the numbers will include 50%, right? 0 to 50%. I don't have my numbers here, but this is 0, this is 50, and this is 100. Okay, now this midpoint level, we said it's called the equilibrium. Okay, any price below this 50% is where we say discount. That means you can buy at this price. That means until price comes here like this, before you begin to think of you are buying the market. Okay, and that's where it's ideal for you. Anything above that 50%, don't be thinking of selling. Of course, there are conferences to this, alright? You don't just do that in abstraction, but begin to know that what I want to be doing at this point is what? Is sell. Instead of people to, even when people are saying they want to buy, you are a smart trader, you want to say you want to sell at that point. Now, take note that I said smart money does not usually buy when price is already at premium. They don't buy when price is at premium. You want to trade like those institutes, like those banks and the like. They don't buy when price is at premium. They buy when price is at discount. So they will wait patiently. That's why market will have to test your emotion, your patience level, and all of those things. Alright? So let me say, for instance, you want to buy let's say iPhone, right? And the original price, you know that the original price of iPhone is 1 million naira. And you went to two shops. One said he's selling at 1,250,000. And you saw one that said they are selling at 1 million. Then you went to another one that said that they are selling at 850. It's same iPhone, it's same product, same spec, right? You will not want to go for the one at random price of 1,250,000. You not want to go for the one that says this price is 1 million, despite the fact that you have seen a price that is 850. Okay, sorry. Since you've seen a price that is 850, you will still see that okay, that one that is 1 million is at equilibrium, and it is between their ranges, right? Why the one that 850 is a discount? So that's one you definitely go for. And so the same thing is applicable to the price. So if price is at the top of a move, you are thinking of buying, Ask yourself, am I buying at discount or I'm buying at premium? That's the first question you must ask yourself. So once you see that you are buying at premium, or you just know that you are losing already, just know that trade is a losing trade. You are already gambling at that point. But once you see that, okay, I'm buying at discount, okay, you know that you are still safe. You are still safe, all right? So that simple question can save you from tons of losing of trades repeatedly. All right, so the next thing is, how do you use premium at discount in actual trading? It's very, very simple. It's very, very simple. I've said it repeatedly, but I'll just need to repeat myself. Let's say you see a bullish market. This is a bullish trend, right? You see a bullish trend. Markets keep creating series of highs and lows, right? You wait for market to pull down to this discount price. Then you look for confirmations. The confirmations like order blocks, fair value gaps, change of character, okay, to see that that's where you will now want to step in, okay. That's where smart money people step in. Once you use all of those things, of course we'll treat all of those things. If you by now you should have know what change of character is all about, okay. And other blocks, fair value gaps, and some other ones to treat them in details as we proceed in these classes, all right. So in a bearish scenario too, you want to see that conference, that price is already in premium, and you want to look for sell opportunity. When I mean bullish, bearish, I mean market is coming down, right? Market is coming down like this. You want to wait for market to retrace again to this place. Then you'll be looking for the same confirmations, either change of character, fair value gap, order block, whichever ones like that. Then you wait them as your confirmations, then you enter the market, or you use the swing highs and swing lows for your confirmations, right? You want to see the three candle market pattern formation. The market has formed a high, a mini candle. Let me redraw it for you. Market has formed this candle one. It forms the second one. I'm talking about in a bearish market now, right? Then it forms, sorry, then the third one around this region, right? So you want to see this three candle pattern formation. In most cases, this first candle will be a pin bar, so a show sign of rejection, right? Let me show you something like that on the chart so that you won't just be seeing something like this here. You see something like this. Let me go to, I think I have a very clean one on 5 minutes time frame that will show you this is how USD you are good. See, you can see something like this. You already see that price is, you know that, okay, let's assume now, see what we mean by swing close and swing high here. From here to here, price has done, let's say, where have Fibonacci? All right. So if I take this range like this, now look at here. Despite the fact that price is coming up like this, I don't want to buy and jump market here. I want to wait for market to come below equilibrium. See what price is. Price came below 50% discount, right? Come below 50%, and I'll begin to look for my confirmation to enter. Now see the three candle pattern formation. See the swing low. See 1, 2, 3. You can see market creating this sharp movement. After the third candle, I can buy. My stop loss below this low here, and target. Of course, this price didn't get here to the TP because currently gold is in a bearish market, right? Gold is bearish. So okay, let's zoom out to look for sell opportunity now. See where price also did again. Price came into this. Now price is actually coming down. I don't just want to jump into it, so I can mark my leg. If I take it like this, let me delete this. So if I mark this leg from here to this low, now I want to join the sell. See what sell market did. See as market, Now I don't just want to join sell. I know the market is coming down, but see as retracement has taken over the market. Now market came into here. Now see the swing lows, swing high created. See this count 1, 1, 2, 3. As here you're already seeing sell patterns that market want to rally away. This could be a confirmation or fair value gap or other blocks like that. You see market coming into this. There is minor fair value gap here. Okay, fair value gap. Let me just explain a bit. Of course, we'll do deeper teaching into it. Fair value gap has to do with 3 candle pattern formation whereby there is imbalance in the movement of candle. That is, when price was running away, right? Normally they're supposed to close each other and don't leave gap among each other. Price supposed to be running and be using their wick to cover each other, right? They're supposed to be using their wick to cover each other. They have to have wick that will cover each other so that there's no gap between their alignment. But when price decided to leave a gap between 3 candles, it moves 3 candles and it leaves a gap between them. Let me say like this now, this space between this candle and this candle, we call them a fair value gap. Oh, sorry, let me unfill this place, right? Something like this. So price come there and then fill up. Price will later come there again. Price will later come back here and fill up and continue in the down direction. So you want to be looking, train your eye to see all of these things, alright? You train your eye to see all of these things. Of course, we'll treat it deeply, but this one just based on premium and discount. So I'm just explaining. So you can see again how price actually come here. So peradventure you miss this your first entry. See the 3 candles. See 1, 2, 3. You see that there's a gap between this wick of this candle and the body and the close of this candle, or the open of this candle rather. And what the price did, price came into the zone and see what it does, and tap in and sell from there, forming another 3 candle pattern formation again, right? The market just opened. Wow, so we have a gap up here. But that's fine. So that is what price, that's how premium and discount is. Alright, so you don't want to sell when price is in a discount. You want to when price is premium. You sell when price is premium. Alright. So to wrap it up, premium and discount is the smart money concept that helps you to trade with logic and not emotion. Alright. So it's about value. You are buying cheap and you are selling high. Okay. It's also help you to filter or let me say it's a filter that tells you when it's safe to trade and when to wait. Alright, so you must know that. So if you master these simple principles, you will already be ahead of many retail traders out there. So in the next video or subsequent videos, we'll deal with premium and discount arrays. You know, there are arrays that which this premium and discount operates with, such that once you see them, you know that okay, this is what you look at first. When market is in premium, there are things you look at first. When market is in discount, there are certain things you look at first. Like that in that priority. When you see the things in that priority, you will know that no market will do this for you. So you tend to make your informed decisions. Alright. So until next time, trade smart and keep winning.